right. Hi, everyone. I am Katrina Martin. I am an enrolled agent and certified tax coach. I am based out of Michigan. I own Wow Tax and Advisory Service. We work with individuals and small business owners, and I specifically help those in the short-term rental space, Airbnb and VRBO, with taxes and tax planning and tax strategy and coaching. So I'll pass this on to Rolanda.
Hello, everybody. My name is Rolanda Watson, and I'm the owner of Rolanda's Tax and Professional Service and RPS Tax Pro. I work with individuals, small business, and I specialize with the transportation industry, helping them to build their business with six figures and beyond. I also work with new and emerging tax professionals and those other business owners looking for coaching to help them to start, stick, and soar their businesses. I am excited about today's discussion.
Very real.
All right, Katrina. All right, Latoya. Let's hear from you.
That's it for you. Hey, everybody, I'm Latoya Jackson, CEO of Professional Bookkeeping Plus, where we help clients in the food service industry. I've been battling this cold. We have clients in the food service industry to keep money in their business by using proven tax strategies. I'm also an enrolled agent as well.
Your mic is cutting out a little, Toya, just to let you know. Yeah, just come closer and it seems to be better, yeah. Uh-oh.
You're in and out.
Yes, in and out. So while you work on your technical difficulties there, we'll go ahead and I'll introduce myself to give Toya a chance to get her audio straightened out. So I'm Shane, also known as Shane the Negotiator, and I help coaches, consultants, and service providers to scale beyond 6 and 7 figures using legal, tax, and accounting strategies. And I'm actually excited about having this conversation today. You guys always hear me say that. I'm always excited about every conversation. So I'm going to pass the mic over to Toya. Hopefully her mic situation has straightened out.
Can you hear me now?
Yes.
Microphone check.
Better.
1, 2, 1, 2.
Yep, we got it.
So I'm the CEO of Professional Bookkeeping Plus. We help clients in the food service industry to keep more money in their business using tax strategies. I'm also an enrolled agent. So just like everybody else, I'm excited about today's topic. Get it started.
Go. All right. So, all right. Thanks, Toya. Thanks, team. So one of the things that we wanted to talk about for our August or July edition is tax season's over. So but the IRS has started to roll out letters, right? So we wanted to talk to you about how to handle those letters. We're going to highlight some of the letters most commonly received this tax season. So I'll start it off, right? So if you guys have received, so you'll notice if you got a letter from the IRS, well, first suggestion, open it immediately.
Yeah, please.
Open it immediately because there's a deadline in there somewhere. But if you look in the upper right corner of the letter, there's a number that's associated with each letter. And that number is important because then that signifies what type of letter you receive. So we're going to talk about what those letters that have been coming out this particular time of year, what those mean. So I'm going to start it off with a CP 2000 letter. So if you got a letter that has the number CP 2000 in the upper right corner, what that letter means is basically that the IRS has information that differs than what you provided on your tax return. So that means if they may have additional income sources that they have generated that maybe you didn't receive, or maybe you filed your return a little too soon and you got some documents after the fact, they have that information and they have recalculated your return based upon the information that they receive. A lot of people in Michigan receive that because, as you know, the unemployment delayed that there's the tax forms this year. The 1099-G didn't come out until late February. So if you filed prior to that late February date and receiving that form, you more than likely got the CP 2000 letter telling you that they have information that differs than what you have because you may not have included your unemployment income on your tax return. So this letter is saying, hey, we got that form, by the way. So you had additional income. So we've recalculated your tax return and either A, reduced your refund amount, B, sometimes increased your refund amount, C, increase the tax that you owe, or D, reduce the tax that you owe. So it's either one of those four things, but that's what that CP 2000 letter is letting you know, that they have information that is different than what you provided on your tax return. All right, so Rolanda will share with you another common letter this summer.
So another letter that we will get from the IRS typically is a CP 501 or the CP 502. Now, again, as Katrina said, you want to make sure that you look at the top right-hand corner of the letter to see what the letter is. Please open the letters. Do not just put them to the side and say you don't want to deal with that, because the longer you wait to address the situation, the more money it's costing you. The more of your time it's going to cost you, either upfront or later. But this CP 501, 502 is the beginning of the string of letters that may lead to your assets being levied. So it's important that you go ahead and you open that letter. This letter is saying how much you owe the IRS. Now, just because the IRS says that you owe them, you may have a different story on that end. But if you wait to respond to the IRS, then you owing them may be an actual issue. For example, I had a client to come to me at the beginning of the year. He had a 2018 tax return. And when he filed his 2018 tax return, he didn't complete doing everything he needed to do. He got a CP 2000 letter. But then after that, he got a CP 501, 502. By the time he came to me, his assets were being threatened. We began to work together. I stopped his assets from being seized, so he was able to get his payroll check. Yay, because that was the problem with him. That's what he was concerned about. But not only did I stop the IRS from seizing his assets or garnishing his payroll, but I was also able to do research. Instead of him owing the IRS close to $15,000, because he took action and we began to work on it, he's getting a refund of over $8,000. That is why it's so important that you go ahead and open that letter and connect with a tax professional. If you have someone that's working on your work, connect with them. If they say they can't help you, then of course connect with us. We'll be able to help you make sure that you're getting the best out of your tax situation with the IRS. Open the letters, respond to them. Don't wait until the end. All right, so let's go with Latoya. What you got?
So the most common form that I've been seeing is the CP 12. So when you get that notice, it's telling you that the IRS has made a correction to your originally filed return. When that happens, they're either reducing your refund, you're now getting a refund, or you could potentially owe. And so I had a client that received the CP-12, and it was due because initially he said he didn't receive the recovery rebate. And so when his return was filed.
Uh-oh, you cutting out.
Latoya.
You lost me again.
You came
Yeah.
back.
You came back.
Yeah.
Came back. So the IRS said, no, we did give you a credit. And so they issued him the CP-12. And he did what Rolanda recommended. Speak to a tax professional. Speak with us. You don't want to assume that they're just right. Find out what your options are.
Yeah, definitely.
Yep.
Don't wait till the last minute. Because sometimes if you do, you've sort of lost the right to, take any action.
Yeah.
So, Shane, on to you.
Okay, so the next letter that I'm going to talk about is the CP 75.
Mm.
So this letter here, that a lot of taxpayers received that when after tax season ended and those letters started coming in. These were the common ones that was coming in. And these were the letters for if you took the earned income credit or the advanced child tax credit or the recovery rebate credit, as we all call it, the STEMI, or the premium tax credit. So those 4 credits is tied to this CP 75. And this letter is pretty much an audit of everyone who claimed one or all of those credit, and it's verifying information. So with identity theft and all of these added credits that was given out during COVID, or in an effort to help us after the pandemic with financially, the IRS had given all of these credits. So these letters are coming out more frequent because they're looking to see if the people who are claiming these credits, if you guys were truthful or not, because it's a high potential for fraud. Because imagine, child tax advance credit, a lot of people, you might have had maybe 3 to 4 kids, you was banking. If you did not opt out of that advanced child tax credit payments, you got, at least minimum 3,000. Some people got 6,000. And if you were married, you and your spouse equally, and you filed jointly. If you were married and you filed jointly, you and your spouse both received those payments. So in addition to that CP 75, that letter, I'm also going to talk about some of those other letters that is associated with the child tax credit and the advanced child tax credit and the earned income tax credit. So those letters, it was a 6416 and 6416A. Both of those letters is literally called the advanced child tax credit. It's like an outreach letter. So that letter was mailed out around June of last year, 2021. And it was pretty much a letter saying that, for the 2021 tax year, you will be eligible to receive the child tax credit payments, and that you were going to be eligible to receive it if you filed your 2020 taxes. The information came from that return. If you didn't file your 2020 taxes, it came from the 2019. So then we had the letter 6417. So this is if you did not opt out of the child tax credit payments, because you did have the option to do so. And surprisingly, many people didn't know that. I don't think you guys were opting out anyway. So if you didn't opt out, you were automatically going to receive these payments if you were going to be eligible. So this letter told you how much payments that you were actually going to receive, and the number of qualifying children that was used to calculate how much money that you're going to be receiving with this as well. And then the final letter is the letter 6419. This was to help reconcile after you have received your advanced child tax credit payments. This letter was now sent out so that you can reconcile it when you file your tax returns. So the monies that you receive, no matter how much you receive, when you went to file your taxes, the remaining portion is now you'll be eligible for that amount when you file your taxes. So you would need this letter to give that to your tax preparer, or if you were happen to do it yourself, to add that with the other half that you would be getting, so that you can now get the full credit that you was entitled to. So if you were spouses, and this was a big one that I know quite a few of my clients were married filing jointly, so they both got a letter. It looks like the exact identical letter. The only thing that was different on the letter was the taxpayers' names. So it would have, spouse A's name, and then the next letter would have spouse B's names, and everything else was identical. So the payments might say $3,000 for that particular spouse, and the other one says $3,000. So if you were filing your return yourself, you may have tossed one of those $3,000 letters to the side because you're like, oh, it's the same thing, I don't need it. But then when you filed, you would have gotten that CP 75 letter. It might have, you received that, and it would say that, either one of those letters that that Latoya mentioned, where they were saying, we have made an adjustment to your refund because of XYZ. And that would have been one of the reasons, because your child tax credit, you would not have had put the appropriate amount. So they would go ahead and subtract, and you would have gotten the less of what you were expecting from that return. So those are, that's one of the other letters that commonly got distributed this year, and it most likely will be distributed that next year as well when we file our next tax season, because so many people took that advanced child tax credit and that earned income tax credit. You didn't have to have a child to be eligible for that. So those were big ones.
Yeah, thanks, Shane. And I think one of the things that I know a lot of people got it was hard not to get the advance. If you had kids that were under 17, it was hard not to get the advanced child tax credit. I had clients who went online to the IRS.gov site and tried to opt out of it. And it was difficult to opt out of it. So people ended up getting, it was a process to opt out. So some people received checks that they didn't necessarily even want to be receiving. So but I think it's important to, if clients can think about, if you're thinking about it, to set up a account on IRS.gov, because once you do, you can kind of go in there and pull your reports, or if you want to, something else up like these advances happen, you can go in there and opt in or opt out, whatever is necessary, where you don't have to kind of do it, where it's going to be as big of a deal to do it. But I think the other thing we wanted to talk about was an important note on each letter. That's your right to representation. So like on Law and Order, when they say you have the right to remain silent, remain silent. You got the same right. You got the same right with these letters. So if you read this letter and it's not crystal clear to you what they're saying, you have the right to representation. You do not have to respond. You got to respond within that deadline, but you don't have to respond on your own. That's where your tax advisor, or reaching out to somebody. If you don't have a tax advisor who specializes in representation, you can reach out to any of us, and we can definitely help you with that. But definitely work with your tax advisors on exercising your right.
You're right.
Yeah,
you don't want to be afraid. I hear a lot of people, they're just afraid of the IRS. And as soon as they get a letter, they just want to give it to me. Like, I got a letter. You got a letter. But, I applaud them for even just, well, thank you. Let's deal with it. You don't want to be afraid of the IRS. They essentially, if we work together, we can take care of it. Another thing with Katrina talking about the account, many times people have past tax returns, and if they just open an account, it's easy for them to go and see who sent what information for them. Your W-2s, your 1099s, you may have moved. You may have moved from one state to another state, and that address, of course, your documents are not going to be forwarded. Your address information has changed. Well, if you have an account, and now they're really pushing the ID.me. If you go ahead and set that account up, you can ensure that you can go in and find out whatever's going on with your tax returns or your information. I've had clients to say, well, I don't know how much I owe. That's your responsibility to know. And if you set up an account, you can go and just look at it for yourself. And you don't have to be on hold for hours and hours.
Sure don't.
And hours.
And hours.
Yeah, and it's like opening a medical, it's like opening your book report or something. They have all of your tax years in there. You can
everything.
Everything's in there. All your transcripts. It's like
medical records, but for finances.
Unfortunately.
And that was the time to do it. When it's not indexed.
And one point I also wanted to make, to make clear, and so that everyone is understanding that, you guys as taxpayers, is that the onus is on you. No matter who you pay to do your taxes, pay or not, whether you got it done for free or you paid a fee to get it done, you are ultimately responsible for the information that is placed on your tax return.
That part.
I have had numerous, and I'm sure these guys can tell you stories that is decades long, of taxpayers who end up getting one of those letters that we just mentioned, or maybe some others that we didn't even speak about. And they say, well, I didn't know this was on my tax return. Well, when you sign at the bottom of that tax return, or if you provide a PIN as your signature, because we're doing e-filing, and a lot of times you guys didn't actually sign last year, you were e-filing. When you saying, okay, I agree, and submit my return, you're agreeing that everything that preparer or whomever is going to put on there, that it is true and it is accurate, and you agree with all of that.
Yeah.
So if it comes back later and there's 6 kids up there and you don't have a chick nor a child, you don't even have a dog, how did these kids get up there? Well, you signed it. So that's why it's very important to get with someone or educate yourself. And if educate yourself at least the bare minimum on how to read those tax forms. And if not, you can reach out to your professional. If your professional don't have time, we always have time. Reach out to any one of us and we will, make sure we go through those returns with you to show you exactly line by line what is what and what it means. Now, you might have to pay us to do that because we don't work for free, just to let you know. However, you will better understand your tax returns, and especially if you are a business owner, you want to know all of those, every line that is on there, because it's going to benefit or hurt you.
Definitely.
Yeah.
Absolutely.
And we didn't want to be, and one of the things that we wanted to talk about with the letters for right now is because they're dropping in the mailboxes, as you know. But another thing is just to let you see that there's a series of things that happen. So before any assets are seized or any bank accounts are frozen, you've got these series of letters that happen long before that.
Yeah.
And that's why we talked about the timeline on those things, because you have 30 days to you have 60 days to respond to this letter, you have 30 days to respond to this letter, you have 30 days to appeal that letter. And as that time starts to narrow out, by the time you get that certified letter, that's when your assets are being frozen. There's a lien on your property, there's a lien on your bank account. And that's when you really have to come out of pocket to get those things released. So before you get to that, long before you get to that, open that first letter. There is something that can be done immediately. It's nothing to call the first time, but once you get to that stage where, okay, we're going to have to pull out the big guns, then that's when you have to start going in your pocket a little deeper. So get it in the beginning, when you open those letters, when you first get them. And let's tackle that problem immediately, because a lot of times it's really not that big of a deal, but as you kind of let it fester, it just kind of grows.
Yeah, it shouldn't be scary. It doesn't have to be scary. A letter doesn't automatically mean someone did something wrong. It doesn't mean that you did something wrong. It doesn't mean that the person who prepared your return did something wrong. So that is the common thing that most people, oh, she done messed up my return. She done messed up my return. Let's pump our brakes, take a deep breath, woosah, something, and let's go through this. Because as I mentioned, the CP 75 letter, if you got that advanced child tax credit, the premium child tax credits, and all those credits that I last spoke about, and you've gotten one of those letters, they're just verifying information. It doesn't mean that you did anything wrong. Most of my parents got those letters this year to verify that, yes, these children are your children, and the kids that they've been blaming all these decades. However, because of the amount that was given out, the IRS want to make sure that, yes, you are the rightful owner that received this. So that's why those letters are going out, and nobody did anything.
And most of these letters are most of the letters are auto-generated based upon certain criteria. It doesn't have anything to do with what your preparer did. It's auto-generated.
That can also be the indication of fraud.
Yes, absolutely. It's to help you ultimately.
It is to help you,
So you definitely want to open those letters and don't put them in the corner and just look at
it. Yeah.
And it's time sensitive. So you have to look at that date. As soon as you see that letter, don't sit it to the side. I'm gonna look at it tomorrow. Look at it today. Pay attention to 2 things: what the letter says and the dates that you have to respond to that. Then you can decide if you're going to sit it down there till tomorrow. But even with that, sitting the letter aside, we have so much going on in our world, we will just forget about it. Go ahead and put it on your phone and set a calendar to either go and speak with your professional or call the IRS yourself and deal with it. But if you call the IRS yourself, we always encourage people. First of all, I encourage people, get the ID number of the person that you're speaking to, the representative that you're speaking to. Get the time that you're talking to them and answer the question exactly.
Don't provide no extra.
Just answer the question.
I'm gonna add commentary after that, right?
Don't tell the extra story of why you got here, because you might be telling too much information. Just answer the question. And at that point, if it's something that you're uncomfortable with, please get a person who speaks taxese. That's what I call it. Get a person that speaks their language. If you understand, every industry, we all have our own language.
Yeah.
If you are a doctor, you do not understand taxese.
Yeah.
And I know we feel like we could go to TurboTax and Tax Act, and it's just, I've had people tell me it's just putting in numbers. Okay. That's not it. Because when you get that letter, it's not just putting in numbers, but understand what's going on, or talk to someone who understands. Go ahead, Katrina.
Yeah, I'm glad I remember, because you know my memory's shot. But no, but the one thing I want to say, when we talked about this a little bit briefly, I'm glad Ro mentioned giving only the information that's requested specifically. And I say that because sometimes we overshare information and you open up a new box, right? I wasn't even asking you about that, and you provided this. So for example, I had a client who was working to get a mortgage and sent over the entire tax return to the mortgage company. And because you sent the whole thing, now I need to review the whole thing. I'm like, no, they said send over the 1040. They said send over the 1040. The 1040 is 2 pages. You send over the 1040. So only check the boxes that are being requested of you. Do not send over information, because now I got to evaluate that. Now I got to look at that. So when you're calling in on your own behalf, you're calling to ask questions, not to answer questions, right?
Exactly.
So don't get on the call and then so and then my kids, and then you call to ask. I got this letter in the mail. It says it's a CP 2000. Can you tell me what this means and what do you need from me? Period.
Absolutely.
Shut it off.
It's almost like, it's almost like, okay, you were speeding and you got stopped by the police officer. He pulls you over and he's like, okay, do you know why I stopped you? So, you might be honest, and yeah, I'm speeding. And he was like, yes, I stopped you because you were speeding. And then you'd be like, yeah, and I was on the phone. And I was gave way too much information. And he's like, oh, right, exactly. So
and you may have looked up my insurance.
Like, wait, what? So it's the same concept. Keep your mouth shut if you were not asked. So if the question is, just like she says, they want your 1040 for you to get a mortgage, you give them that 1040, it says 1040, and then the signature page that goes along with that. Don't give them the states, don't give them the form, don't give them your schedules,
all of that.
owners, none of that, nothing.
And if you don't feel comfortable answering those questions,
you say that.
Say that.
You can't, you have the right
to. A professional.
I feel comfortable. I'm not qualified for this. And it's
right.
okay.
I want people to start getting comfortable with the IRS and taxes, because it's like, especially, we're, mainly speaking to business owners, you guys have to get comfortable with the IRS, with taxes, with accounting, because that is the language that is going to help you grow your business. So don't be afraid, just as the same, if you go to court, you're not going to go without a lawyer. Even if you are a lawyer, you may get a lawyer to represent you, because you're under pressure and you may not at the time be able to think at your best because you're in the hot seat.
Or that may not be an area that you specialize in. You may not be a trial attorney, or you may not be privy to whatever the topic is. You really need somebody to operate on your behalf. We'll jump on calls with you and speak on your behalf, act as your power of attorney. Matter of fact, you don't even have to be on the call. We can just speak on your behalf if we have power of attorney for you, and we can just jump in your shoes and walk the walk for you. So if you're fearful, you don't have to have those conversations. We can have those on your behalf and go to bat for you. This is not, and that's what one of the reasons we're doing this series is, because we want to stress that your tax advisor is not a once in a year I kiss you relationship. It's not. We date all year round, right?
Yes,
so we go together. We go together. We are not just here for once a year. We don't go on a date once a year. This is a year-long thing. You get paid all year. You earn money all year. You're taxed all year.
You need to be about your business.
Your advisor has to be in. You have to have this communication year round. you know, so, and we want to start facilitating those conversations year round. So that's why we're having these conversations with you.
Yeah.
And honestly, if you do have that relationship with your tax advisor all year, it's less likely that you'll receive those letters, especially the I owe the IRS letters, because we're strategically planning with you all year. Before you buy that additional truck, we're looking at your expenses. We're looking at your income. Before you buy that next real estate property, we are walking with you in your business. And it's nothing like having a team in your business, because you can't do everything.
Yeah.
As a business owner, you can't do everything. So you need some trusted partners with you to walk this thing out.
Yeah. And that leads into our tax planning conversation too. You know, we wanted to talk about what tax planning is, and kind of take that. It's not just a statement, it's actually an ongoing thing where you're actually looking at your financial picture year round. Because I you know, we all deal with this because we have conversations amongst each other where we have clients that, you know, small business owners who haven't done any accounting all year, and then at the end of the year are, you know, kind of coming and we're recreating a full year's picture for you. And you're still price conscious, you know, it's like you forego all the accounting efforts all year, and then you will kind of want this one catch-all thing. So I have people who've reached out to me and like, I'm not working with my last advisor because they didn't help me with this. I owed a tax bill. And I'm like, well, what was the relationship? Well, they filed my taxes. Okay, so that was your tax preparer. That was not your tax advisor. That was your preparer. You paid them for a one-time engagement. That was not for an ongoing service of helping advise you. So you got to be very clear as business owners. There is a process to having an advisor that helps you to understand the numbers in your business, track the numbers in your business, and optimize to the numbers in your business. It does not happen on February 15th. It happens right now. It happens in August. It happens in September. And we want to be very clear that that planning process needs to happen in order for you to really get the full benefit of filing your taxes at the beginning of the new year.
It is an ongoing relationship. And if you're wanting the best out of it as a taxpayer, having a business, or even growing your business, understanding the potholes of your particular industry, you're going to want someone walking with you through this throughout the year. Now, if you just want somebody to file your taxes, that's a one and done. Don't get mad when you say,
thank you, ma'am.
Yeah, wham, bam, thank you, ma'am. Don't get mad when you say, I owe. They're not even helping me.
You know my favorite saying is garbage in, garbage out. Because if you are giving garbage numbers, and I say garbage numbers that you have not vetted these numbers, you do not know for sure because you haven't done any reporting all year. You don't know for sure if this is the actual income to the cent. You don't know if this is the expense to the expense. You don't know. So you're missing income probably, or missing expenses probably. So the number on the output is not going to be accurate if the input wasn't accurate.
Yeah, and that's the very meaning of a trusted advisor. We're coming to you, having these conversations. You didn't go into business to do accounting or tax planning, or you started business to have an Airbnb, or to be a therapist, or to own a fleet, or to own a store. Do what you do best, because we're doing what we do best.
Yeah, absolutely.
And that's what an advisor is.
Yeah, and each niche, each tax and accounting business may have particular clients in particular areas that, you know, we specialize in when it comes to tax planning. As for instance, the four of us here, although we are all in tax and accounting, we specialize in a particular area with business owners. So my niche is coaches, consultants, and service providers. You know, Latoya is a restaurant, food truck owners. Rolanda has trucking industry, and Katrina has Airbnb and short-term rental. So we're all different. So the tax planning is going to be specific to those particular industries. Now, yes, we can, all of us is very much qualified to help somebody. If somebody that would generally should be going to Rolanda comes to me to get those services done, I'm capable of helping them. I'm going to have limitations. So the next thing I'm going to do two things. I'm going to say, well, this is above my capabilities, and I'm going to refer you to Rolanda, or I'm going to reach out to Rolanda and say, hey, I have this client that has this. Can you help me help that client? Those are the two things that's going to happen, because we are not versed in every area. A tax law is so broad. There's no way we can know every area. So we specialize in certain areas so that we can best serve you. So if we are telling you we are specialists and you need help from a specialist, why not come to the specialist to get the help that you need?
Right.
Yeah, and I just, matter of fact, I just had a prospective client call right before we jumped on this afternoon. And, you know, I always have people lay out what's going on in their business, and this is a successful business, but it's kind of all over the place.
Yeah.
And I find that with a lot of business owners, you know, you just kind of grow and go. And then this kind of gets put on the back burner, and the accounting piece just keeps getting put on the back burner.
Yeah.
This is really the foundation of your business. You're in business to make money. And in order to make money, you got to track money and you got to report on money. We want to help in every key area of that. And you can't do that in a vacuum one time a year. You have to do that. If you're making money every day, it has to be tracked at some point, at least on a monthly basis or quarterly basis. It has to be tracked. And so this is the spot where a lot of people forego in their business, but this is a spot that's really going to help propel your business to the next level. You cannot scale and grow a business if your accounting part of your business, your financial foundation of your business is not in order.
Absolutely. You don't know your numbers. We're not saying for you to be experts in it, because that's the place that we take to pay attention to your numbers. But you definitely want to know your numbers. I promise you, if you know your numbers, you won't get many letters from the IRS.
Absolutely. And if you do, it's not going to be a sweat off your back. You can be like, oh, you know, we just give them what we need, because everything is going to be in a nice neat package for them. And I just wanted to share, I guess, you know, we can all go and share a tax planning situation, or why, but in our particular niche, you know, would need to put tax planning, and, you know, to share with you so you guys can get an idea of that. So for you guys, coaches, consultants, and service providers, mainly coaches and consultants, you know, as part of tax planning is a lot of the times you guys didn't fully transition into 100% entrepreneurs yet. You may have a job working W-2, or you may have transitioned into your business, but because you have a practice, you might be a therapist or something, you may be doing work outside of your business with using a 1099. So a lot of times when people are 1099s, you guys are not paying estimated taxes on the 1099 because you think that's small money, because you're not really tracking the monies that you're getting from there. So you're like, oh, I'll worry about that later. So you may be estimated tax paying for your primary business. Well, then when you sit down to do your taxes, you realize you about made 6 figures in that 1099 and you didn't pay any taxes for that. So that's where a part of tax planning will come in throughout the year, because when you would sit with your professional, you know, every quarter at least, I would say, and say, hey, they'll ask you questions like, okay, so how much did you make from your W-2 job? Did you have any 1099? Do you have any other income? They'll look at how much taxes that you've paid so far and say, okay, based on what you've paid and where you are revenue wise, I suggest you add this amount, you know, as withholdings on your W-2 to offset some of the taxes that you may owe, or to pay more in estimated taxes. Or, hey, it's not the best of year right now. You've already paid so much in taxes, so you don't need to pay any more estimated taxes because you're kind of falling short this year. So that's an example of niche specific, a type of tax planning that we would essentially do to help you so you do not owe next year.
Yeah, one of my tax clients, when they sat down with me, she was like, I'm so tired of owing. Every year we owe. What are we doing? And what we're going to do this year, we've been meeting every quarter. It's different when you know you're going to owe $2,000 in a year versus $2,000 and I need it now.
Mm-hmm.
Now that you know that you are, let's work on decreasing that liability.
Mhm.
What are you doing with your withholdings? What are you doing with retirement? We look at each scenario, not just one, not just two, so many different options.
Mhm.
And as Shane said, it's specific to you, your situation, and your business. So
One of the things I've noticed with those in the trucking industry is they don't really understand their business structure and how it affects their tax liability. For example, I had a few truckers who were paying their drivers. They had several drivers. They were paying their drivers W-2, and for some reason, the payroll company that they signed up with told them that they could be W-2 as well. However, they were a single member LLC, single member liability company. It's just the same as being a sole proprietor in the IRS's eyes. You are a disregarded entity, so you're treated just like a sole proprietor. Sole proprietors should not be W-2.
Right.
And if you could imagine, these truck drivers are spending money on payroll taxes, and truck drivers' worlds are so fast. They're getting that next load. They're making that money, and they're spending that money on the drivers, and they look up, they're just doing what you tell them to do, pay payroll. And once you tell them, excuse me, you're not supposed to be on payroll, so we need to change that, or we need to see if you qualify for an S Corp. It's not just about the money sometimes. It's the investment of time that you spent because you did not plan. It is the money, but then it's a trust factor because somebody told you something that was not right, and they were supposed to be the expert, and now you have to pay for it. I've gotten a few truckers out of that situation, took a look at their books, decided if they needed to be an S Corp, and if they didn't need to be an S Corp, we put them on a plan so that there's a separate account for you to set aside for taxes. It can be done if you just sit down and let us work through your world.
right.
And in the tax industry, well, in every industry, no business is the same.
Right.
So what works for your homeboy, what works for your homegirl will not work for you. You got to talk to somebody to let them know about your world so that we can get it together. Know your business structure.
Yeah, and I'll second that, Ro, because one of the things that I found, and I'll speak specifically to those doing Airbnb or short-term rentals in the rental arbitrage space. So rental arbitrage is where you're basically subletting a property. You don't actually own the property, you're subletting the property. And I find this with a lot of clients, people get into this and it's marketed heavily. And a lot of times what I find is people LLC themselves to death. They will get they'll arbitrage this property, put an LLC on it, put an LLC. They'll, and you get an LLC, you get an LLC, and there's LLCs going all around. However, like Rolanda just said, an LLC as a single member is a disregarded entity, which means it lives on your personal tax return. So you have not, your intention was to incorporate your business, that's not what you did.
That's not.
It lives on your personal tax return. And in the arbitrage space, there's a lot of money to be made. And anytime you make over, say, $50,000, your self-employment tax shoots through the roof. And if you combine that and you still have W-2 income coming in on top of that,
Yes.
you just increased your tax bracket to the top of the tier. And now a lot of your profits that you've brought into your business, because I'm going to cover something else in a second, because what your tax tier is increased to the top of the tier. So now you're paying this huge tax bill. Not only that, the arbitrage space is expensive because you're paying rental, you're paying additional rent on the property, you're paying all of these expenses. And guess what? Since you don't own the property, you don't get to depreciate a lot of the things that the owner of the property can depreciate.
Yeah.
So you lose that benefit of depreciating that property. A lot of the things that you restored in the property, if you replace a furnace, an AC unit, you do not get to depreciate those costs. because you don't actually own that
Own the
property. Can you
property.
write some of that
Yeah.
out? Can you write some of it off at section 179? Yes, you can. But as far as some of the huge tax advantages, like doing a cost seg, you can't do that if you don't own the property. So if you're in the rental arbitrage space, you have to be very proactive about planning and structuring your business properly. And I hear people in the space when they're coaching to this to do arbitrage, they're telling you get an LLC, but they're not telling you the steps to that. Okay, it's cool to get an LLC to limit your liability, but that is not a structure for tax advantage. It is not a structure for tax advantage. So if anybody's in that space, I implore you to reach out to DM me, because I find this year was eye-opening for a lot of my clients that entered this space, because they were like, oh my God, I thought I was incorporating my business. No, limited LLC, limited liability company. It's just limiting your liability for lawsuits. It just protects your personal assets. It does nothing as far as the structure for taxes.
And let me chime back in with this. I've spoken to a few business owners, and they say, well, I talked to my lawyer about it. This is why I say it is so important to have a team. Your lawyer is going to look to protect you legally. Your tax advisor is going to look to protect you and to limit your tax liability. They're two separate things. And it's not that anyone is wrong. Either one of the professions are wrong, but you're getting a piece of the scope. And as a business owner, you need to be able to look at it, the whole picture, to make a quality decision for your business.
And it's okay to sit everybody down once a year to discuss what the goals are going to be. And trust me, it can work. If everyone sit down together, and like the four of us, we have all our different professions. If we're going to sit down together and come up with a plan to help you, in addition to the information that you give to us, we can actually help you in your business. So get the team together, get your powerhouse.
Exactly. Your power team.
Right. And I wanted one thing that I wanted to mention, because I usually forget to mention this part, is everyone wants these holding companies. Stay off of YouTube and Google, you guys. Because everyone's talking about, get you a holding company, get you this and this and that. Now, these things can have really great tax benefits. It can also be useless. If you don't have a really great reason why you want to have holding companies beyond, you've heard somebody say, get you a holding company, because you don't even know why. If you don't know why you have a holding company, do not get a holding company.
Don't get it.
Because they're like, oh, I have this LLC, that LLC, and I want to have all those LLC go up to this holding company because that's what someone on YouTube told you, or TikTok. Well, why did they tell you that? Do you have a C corporation? Do you have an S corporation? Like, what exactly are you planning on doing? What is your plans? And if you don't understand that, then you need to sit with the lawyer, your tax accountant, to really sit down and figure out what is your ultimate goal, because you might come to realize that it's pointless. That income is flowing through to you anyway. If you're not a corporation, a C corporation, the income is flowing to you no matter what. So you literally passing it check to this person, and that person goes to the holding company, and then you file the taxes. Then you just pass it down the line. It's not saving you any more in taxes or any less.
Yeah,
but it is costing you more to operate.
Right. Absolutely. Absolutely.
Yeah, you definitely need a team. And like Rolanda and Shane said, you gotta have everybody has their wheelhouse, and you gotta operate in your gifts. If you don't, lawyers don't know tax, and some notes, unless you're a tax attorney, that's not tax is not your specialty. And we're not lawyers. So what we can do is we can talk tax and we can talk tax law, but as far as some people don't know that. So we stay in our lane. Another topic we wanted to talk about too today, I wanted to make sure we get it in before we run out of time, is we wanted to talk about the 1099K tax changes.
Oh yeah.
So who wants to ping that up?
Well, that's gonna catch a lot of people off guard. And we're talking your hairstylist, nail salon, your barber, the guy that does your lawn. Because so in 2021, I think it was what, $20,000 limit
Mhm.
for so many transactions.
Mhm.
2022, they brought that down to $600. So if you're receiving $600 or more via Cash App, Zelle, Venmo,
Mhm.
all these third party,
Right.
they're send you a 1099.
Mhm.
Now, when you get that,
Oh, you cutting out there?
You're fading out, Toya. You're gone.
Yeah, you're gone. Yeah, she said what she was saying, as she get her mic together. If you have Venmo, Cash App, and all of those third-party processors that you've been using, and if you've made at least $600, that you're going to be received that 1099 for those payments, whereas in those previous years, you were not issued 1099, and most people were not reporting it. Some was, because not everybody was just not reporting income, but if you watch back this replay, 9 times out of 10, you're one of those people that didn't report all of your income. I mean, let's face it, you didn't, because if no one's watching, you didn't do it. And now it's cracking down, it's always been in effect. So it's not a new law, because I had people last year, oh my God, that new law passed. And I'm like, oh, hold up, it's not new. It's always been there. You always were supposed to report it. You did.
okay,
So now they
Hear me
brought
now.
that threshold from up here because you guys weren't listening. So they brought it down here now. So you have to report it, or else you would get one of those nice little letters we were just talking about earlier.
right, and don't throw it away.
Don't throw it away.
Don't throw it away. Like, it's not a W-2.
Yeah.
It's not gonna
You
work
know
out.
what? You got to find the bright spot and stuff, and at least that's my approach. But so the bright spot for this law change, I mean, it is going to be an increased tax. However, it's going to force your hand to do something you should have been doing anyway, because ultimately not reporting, and I'm not talking about to pay the IRS. That ain't what I'm talking about. I ain't that kind of Girl Scout. But what I'm saying is ultimately it's going to help you, because a lot of people who were making money couldn't get the things that they wanted to get because they were not reporting the income. So that house that you couldn't qualify for because you didn't have the income to substantiate it, now they're gonna force your hand to have the income to substantiate it. So, but this also implores you to make sure that you are doing some planning and keeping track of things, because you don't want to be surprised at the beginning of the year. All of a sudden, you went from getting a refund to now you owe this crazy amount, because now you got this huge new income stream. So make it work for you. You got what, 4 or 5 months left. Make it make sense. So start to look at your third party vendors and see what you owe them. And then start looking at your structure. If you're set up as a sole proprietor or you're set up as an LLC, it may be time to start looking at incorporating your business and getting right on paper. And ultimately, that's going to help you, because now all of a sudden you're on paper. You can start qualifying for credit, for business credit. You can start to move like a true business owner.
Yes,
exactly.
And not be under the radar. So look at it as kind of forcing your hand to do the right thing, but ultimately it's going to benefit you in the end.
Because put it this way, just like as a quick thing, think of this. Okay, Zelle, you had $15,000 in Zelle that you didn't report. Venmo, you have another $15,000 in Venmo you did not report. And in Cash App, another $15,000 in Cash App you did not report, because all of these fell under the old threshold before. So it wasn't 200 transactions, you didn't make 20,000, you're under, but it's 15K each. 15,000, another 15,000, you got 60
right there.
60 grand that you did not report in income. So when you actually reported the other income that you actually reported, that may have said $40,000. You have 6 figures right there. So now you're trying to get that house and you providing the documentation after you had all your expenses, is 40,000 left. And they're like, oh, you just didn't make enough. You didn't qualify. But then if you had provided this 60 grand that's sitting over here that you didn't even account for, boom, now you've made the eligibility to get a loan, to get that house, to get that car, to get pretty much whatever it is that you need. So just as Katrina just mentioned, reporting this stuff is not just so the IRS can tax you, because you can report all of this and not pay a single dime in taxes.
And that's
if you get with one of us, that is.
And there's the thing, having a tax professional find somebody who is tax
But
planning.
but now you've increased your net worth,
Yeah,
so,
exactly.
and that matters, because flying under that radar does not benefit you long term. And you got to think about it too. So especially if you're in those cash-based businesses, you got to retire at some point.
Yeah.
You know what I'm saying?
That part.
You
Mhm.
got to retire at some point. So you need to have, if you're not saving for retirement, at least you need to start letting Social Security save for you, somebody. But it comes with planning. So we all gotta put our big girl pants on and big boy pants on and just start operating in a way that's gonna benefit us long term and stop thinking so short-sighted
Yeah.
and
Yeah.
thinking in the right now and start thinking, what's our long game? What's our end
Yeah.
game? And start planning that way.
Absolutely.
I know a lot of business, let me get this right quick, Shane. I know a lot of businesses say when they start their businesses, one of their main thoughts are they want to leave something for their children.
Mhm.
They want freedom and they want to leave something for their children. Well, honestly, if you do your business the right way, you're beginning to leave a legacy for your children, not only with getting your own home, but you're teaching your children how to operate on their own in business so that when something happens to you, they already have something to step forward on with you in business. Even if you didn't have a legacy left for you, you should want to be the one that leaves the legacy for those coming behind you. And that's going to start with you handling your business. Be about your business.
Be about your business.
Absolutely.
So we can take some questions or that I saw popped up or some comments. So we did have Aaron earlier said, are you saying what you don't know can hurt you or even lose you money? That's
Yes.
when I think that's when Katrina was talking. And then that's when he made that comment. That's absolutely correct. And then Janice asked the question, she said, what about a trust for property? Because when we're talking about, holding companies and all of those companies and talking to lawyers, that's when she asked that question. So does anybody want to answer that for her?
I say, like we said, have a sit down with an attorney and your tax advisor, have that round table, because in some instances it can benefit you. And in some instances it doesn't, sometimes you're just doing things because, because it's available to you. In some instances that does work. In some instances, but it's unique to every individual. It's not a one size fits all by any approach. And I think that's where a lot of people are jumping into, I'm going to do these, I'm going to get a trust, I'm going to get these holding companies, I'm going to do all these things with the goal that they're separating those things and doing some tax strategies and advantages. There's a lot of ways to do that without even doing those things. But sometimes it does make sense to do that. But like I said, you have to look at the individual as a whole and not everybody you get one and you get one and you get one. It's not
Exactly. That's good.
Yeah, because the common thing that I hear around that, have everything and own nothing. That's what I hear that's going around a lot when it comes to these holding companies and these creating trusts and things like that. But if it's like, if you're not making like some like really good money out there, and you don't have a reason why you're doing these trusts and these holding companies besides because you've heard it, it's not benefiting you in the way that you think that it will. It's actually hurting you financially.
Yeah. So you definitely have to look to see how that's going to work best for the individual. It's themselves, So not one size fits all for sure. All right, guys, we're at 5:01. Any last thoughts?
Did we address Aaron's question?
What was Aaron's question?
It wasn't really a question. He was just saying, it was a question where he said, are you saying
don't know?
that you don't know? Yeah, can hurt you or even lose your money.
Yep.
Yes. Yes, the answer to that is absolutely yes.
You should always be learning, always be learning.
Absolutely, especially
and listening to those who know in their particular area.
Exactly, especially if you have a business, you definitely.
So we're all tagged on Shane's post and we've all shared it to our pages. If you'd like to chat with any of us, feel free to reach out to us. We'd love to chat with you. If you have any questions, please comment and feel free to share, please share.
Please share.
Let us know if you'd like to hear about anything in the upcoming Real Talk, Tax Talk, and we'll see you next time.
Yep. So we are generally here, just to let them know, we're generally here once a month. So we'll be back again. It's usually around the 3rd or the 4th week, depending on when the Tuesday falls. and we come back then. So the date for next month, just so you kind of guys get a heads up and you can plan accordingly to have your questions for the next topic, it would be around August 23rd. That would be the week tentatively. So I see Aaron said something else. He says, how do you know you've picked the best bookkeeper for you being if you're a new business?
What was the question?
How do you know?
How do you know if you've picked the best bookkeeper for when you're if you're a new business? How do you know that you have the correct bookkeeper?
If you are interviewing for a bookkeeper, one, they're going to be very much interested in your business. But it's not just a bookkeeper. They're also going to be advising you on how to set up your book, making sure your expenses are properly done, making sure you're set up for success from the beginning. So when you're having that conversation, as a new business owner, ask those questions. I mean, find out other people that they've serviced.
Mhm,
You want to make sure they're a good fit for you as well.
mhm.
Yeah.
Yeah.
Yep.
And
I
I think giving you that good advice.
Mm-hmm. Mm-hmm.
And the other thing too is similar to how we're specialized in different areas. You may want to find one that specializes in the type of book area for your business, because there's some bookkeepers that specialize in e-commerce. There's some that specialize in real estate. So if you can find one that has your particular business niche, that's probably ideal because they're used to working in your industry and
Right.
know how your business kind of flows and some of the things to watch out for. It can add added value to you outside of just reporting your numbers and reconciling your numbers. They can add additional, they have other people in that industry where they
Right.
can add
Yeah.
additional insight of what's working for people and what the KPIs are for that business.
Right. You
Definitely.
should definitely be meeting more than just, they shouldn't just be doing your books and you don't meet. Do your books, hand you those reports, and then sayonara until you need it done again for the next
Right.
year.
They
You
should
should
be
be
sitting
meeting
down with you.
constantly to really discuss your ins, your what's coming in and what's going out, and how you can best do budgeting and how you can best increase your income with the different techniques and strategies that's available to you. And you definitely want to interview by asking specific questions about your business and make sure that they can help you in your business.
Right.
One thing that I'll say is, I'm not sure what industry you're in, Mr. Jackson, but you want to make sure that you look at the classes. If they can break out your classes. So like with truckers, you can look at what they're spending on each truck. So whatever your business is, wherever your highest expenses are, you want to make sure that that bookkeeper is able to, and is proactive to look at how to minimize your expenses so that you can make sure your profits are on key, and that they're always talking to you about the ebbs and flows of your business. So
And
just building that relationship.
Yeah.
And especially if you're spending a lot, your bookkeeper should definitely be, sitting down with you and trying to tell you like, hey, you're spending a lot in this area. These are some areas that you could potentially cut back on. Maybe, in other areas, you can put a little bit more of that funds in. So you might be spending too much in, purchasing particular equipments, and then they may talk to you about, instead of spending it on this types of equipment, maybe you purchase this other type instead, and you can kind of save to now free up some of that asset to put it someplace else. So those are all ways that, you can, that can help you, which is part of tax planning as well, because ultimately that's going to help you when it's time to file.
Mhm.
Okay.
So thank you for asking that question, and thank you everyone who have joined in our discussion today. And again, August 23rd will be our third meeting. So if you missed that first one, you'll catch it. Look on one of our pages, you'll find that previous one. They'll let us know. We'll share it with you. So thank you all again for joining in, and thank you for those questions. And as always, I think the ladies on the panel who have always provided the great value. So we are ending out now until next time. So hit us up if you have any questions or you need any help with your specific situation.
Have a great week.
Good night.
Bye.